Hi, I'm Divya Shikha, student of 2019-21 batch at IIM Trichy, and in this video I'm going to talk about the 4 factors that drive an emerging economy. So first let's talk about what is an emerging economy or emerging market. So they are basically the developing countries, the nations that are investing more in productive capacity. They are moving away from their traditional economy, which relies heavily on agriculture and export of raw materials. They're moving towards a mixed economy and they're rapidly industrializing. So there are 5 characteristics that define an emerging market. The first one is lower than average per capita income. Second, brisk economic growth. Third, high volatility. Fourth, currency swings. And the fifth is potential for growth. Now, few countries around the world which can be classified as an emerging market could be India, Indonesia, Malaysia, Mexico, etc. So let's talk about the factors that drive an emerging market. Now, when you compare these companies to these markets to developed markets like USA or UK, Europe, so some risks are very difficult to predict. But then there are broadly four factors that I have identified, which can affect emerging market performance and what they can mean for an international investor, because the growth will not happen unless and until we have more and more international investors. The first one is developed market demand. So now many emerging market countries, they manufacture their products or they sell their services. Many emerging markets, they sell all these services to the developed market. We can see that in India as well, a lot of services are provided from India to US companies or the European companies. China make all the kinds of good for US and Europe. So a downturn in developed economies can therefore have a negative impact on emerging markets that rely a lot on the demand. As we can see, after the 2008 financial crisis, many developing countries have struggled to return to their normal growth rates. The second factor is the domestic economy performances. Many emerging countries are driven by domestic demand rather than export demand. For example, exports account for just $260 billion of India's $2.45 trillion economy, or about 10% of its total economic output. So we can see that domestic factors like consumption and politics have a big influence on these emerging markets. Oftentimes, emerging market economies evolve from an export-driven economy to a domestic-focused economy. So I believe the domestically powered economic growth is widely viewed as more stable than the export-driven growth, since it doesn't depend on external factors. For example, if India as a country is totally dependent on the services from revenue from the services that we provide to US or UK, and some downturn, some crisis happens over there, so our economy would be completely destroyed. So it's important to have a focus on domestic economy performance as well. The third would be currency market dynamics. So most of the emerging market economies have unstable local currencies and must issue debt in dollar denominated bonds. So when the US dollar rises, these debts become costlier to service for emerging markets that earn revenue in local currency. A higher dollar valuation also implies higher interest rates, which tend to draw capital away from these emerging markets and makes it expensive for emerging markets to raise future capitals. Now, this is something that is not in control of an emerging market. The currency market tends to be unpredictable in short term, and rising US interest rates could lead to a further rally if hikes takes place faster than anticipated. But while designing future plans for an emerging market, they should keep these factors also in consideration. And the last factor is the commodity performance. Now, many emerging market countries are net exporters of commodities, which makes them sensitive to change in the prices of that. For example, Russia is a large exporter of natural gas to Europe and Brazil, and Brazil exports iron ore, soybeans, coffee, and crude oil to China and US. A downturn in these commodities could have a dramatic impact on the revenue generated by state-owned and private enterprises in these countries. So the prices have been dramatically fallen since 2011 due to slower end market demand, but the global economic recovery helped boosting in that. Since 2016, metal commodities have experienced a significant rebound that has helped many emerging markets. So most of these countries should not completely depend upon the export of these commodities. For example, India is one of the largest provider of IT services. What if the demand for these services go down? So what would be the impact then? Or the price is even more subsidized. So that could be a problem for India. So while designing any strategy for emerging markets, they should keep in consideration these factors. A domestic driven growth is more stable, and that should be an important part of the plan. And for the developed economies, emerging markets are a great way to diversify the portfolio. So this was all my understanding about the factors that can drive an emerging market as of now. And given the recent disturbance in the global economies, countries like India, Indonesia should keep the factors like these in consideration before going further, because even the developed economies are suffering as of now. Thank you for your time.